like to welcome you all to March 14th, Startup Cities, the future of real estate. We're really excited to have a really interesting panel. As a reminder, there's refreshments in the back. Please deliver and come through and take some of those off our plate. So to jump right in, what is Startup Cities? We are an event series that seeks to put on events that bring the startup methodology you see a lot within the software world into more traditional industries like real estate, urbanism, and other facets that tangent those two things. We've hosted a couple of events with a lot of great speakers, attendees, and I think part of the experience as well is not only the content, but the community that it fosters, and hopefully the people that you'll meet after the panel concludes. Our audience is made up of those from the tech world, from the real estate world, finance, as well as academia, where we try to bring some of these different perspectives together to make sure that we're getting a full, well-rounded view of these topics. Some of our past speakers have been someone like Patrick Schumacher of Zaha Hadid Architects, and he talks a lot more from the perspective of an architect dealing and trying to innovate in the existing structure that we have in the industry today. Other speakers have included Sanford Akita from Purchase College, who's an economist that studies urban issues quite a bit. Also, we had Amanda Gutterman from Consensus, which is a blockchain studio out in Brooklyn, and she's talking a lot about the way blockchain can innovate these industries. Some of the past partners we've had have included Microsoft, Barclays, UrbanX Accelerator, NYU, Digital.NYC, 1517 Fund. And so we're bringing together a really good group of people from an institutional level that seek to solve these very same problems. So, one second. Don't you love how this always happens when you're presenting? All right. Day 6. Okay, and so, on that note, we look at various ways that we can bring in our speakers and their unique expertise to look at certain things like research that the UN is doing, where by 2050 more than half the world will be urbanized. Or coming more locally to New York and seeing that 40% of the buildings in Manhattan could not be built today, and trying to understand from maybe a regulatory angle, what is putting the brakes on innovation, disruption, and progress in these industries. And ultimately, some of the goals of these events is to start conversations that turn into solutions. And so that's where we get people together, talking about this, meeting afterwards, and then forming companies, pivoting their existing companies in ways that benefit them and society. And so ultimately, we're trying to answer what are cities? We're trying to answer how do cities operate? How do you build within them from micro level to macro level? And also answering why do we have cities? Why is urbanization good? Why are all these things that we come to in this hub of jobs and economic activity? Why are these engines of progress? And so, moving more specifically to tonight's event, I want to thank Galvanize. This is the building that you're currently residing in. They are a co-working space, and I highly recommend you checking out their product offerings and services afterwards. As well as our live streaming partner, Urbanist. They explore cities and partner with brands to tell innovative stories. And you can catch them on Facebook Live at The Urbanist. And I would like to introduce our partner for the evening, Harvard Real Estate Weekend, and their co-chair, Grenga.
Thank you so much, Peter. I'm glad that we could join forces tonight in the real estate capital of the world, New York City. The mission of Startup Cities is certainly one that Harvard Real Estate Weekend firmly believes in and seeks to promote. So my name is Grenga, and I'm the co-chair of the 7th Annual Harvard Real Estate Weekend that will take place on March 24th and 25th. Real Estate Weekend is co-hosted by the Real Estate Clubs of the Graduate School of Design and the Harvard Business School. And for the first time ever, in recognition of our special collaboration between our disciplines, the conference will take place at both the Design School and the Business School this year. So you may be wondering, what do you get when you combine the avant-garde of design and urbanist thinking with the West Point of capitalism? And the answer is Real Estate Weekend. It's a 2-day conference featuring workshops, venture competition, panels with leading voices in the industry, as well as networking opportunities and more. The whole weekend is a showcase for how real estate is truly an amalgam of different fields: business, architecture, and law. It'll be a great learning experience and networking opportunity for anybody in the real estate industry. This year, speakers at our conference will represent over 40 world-class firms that encompass nearly every aspect of the industry, ranging from construction to owners, developers, commercial brokers, government agencies, private equity investors, startups, and more. A few of the firms represented at our conference will be responsible for tens of millions of square feet under development in New York City. These projects will transform the way New Yorkers live, work, and play in the near future, and are just a few of the marquee projects that our speakers are involved with. Saturday will feature the Development Workshop, a day-long exercise in which students and professionals will team up to explore a mixed-use development and an actual site making its way through Boston city planning at this moment. This year's site is Alston Yards, which is a development proposal in partnership with Bizzuto, New England Development, Southside Investment Partners, and Stop & Shop. At the end of the workshop, teams will present their proposals to a jury of industry executives and senior faculty. Saturday will also feature the Real Estate Venture Competition. Now in its 4th year, the Real Estate Venture Competition is a pitch competition for early stage companies tackling real estate challenges. This year, 10 finalists will compete for a $33,000 purse. We're fortunate to host Scott Malkin as the keynote speaker. Scott is the co-founder and chairman of Value Retail. He had the brilliant idea to bring luxury outlets to Europe, and today Value Retail achieves some of the highest sales densities of any retailer globally. In the face of retail headwinds, Scott is reimagining what shopping experiences can be, blurring the lines between retail and hospitality, and he will be discussing the future of physical retail in a digital world. The meat and potatoes of our conference are our panel discussions, which feature industry leaders across a wide range of professions. Historically, we've hosted panels on real estate private equity, hospitality, adaptive reuse and placemaking, and mega mixed-use developments. This year, our lineup includes some of the top executives at the firms that are having a tremendous impact on shaping our built environment. We're pleased to be able to offer a new panel this year focused on women executives in real estate. 5 panelists, the majority of which are CEOs or managing principals of firms that they founded, will share valuable career advice and their perspectives on commercial brokerage, development, and investing. So despite all these great viewpoints across the real estate spectrum, we felt that we were missing an important piece. It was bothering us that real estate is the largest asset class globally, and yet it remains among the least changed by technology. Real estate's woes can be summed up in these 2 charts. Gross value added by manufacturing has improved by 8x. However, real estate is flat since 1947, when Harry Truman was the president. Further, real estate scores low marks among sectors that are embracing digitalization. In fact, even Apple, Our nation's paradigm of design and seamless technology could not overcome real estate inefficiencies, and their headquarters was delivered 2 years late and $2 billion over budget. I bet Tim Cook wished he had used honest buildings. However, there's good news. PropTech is trending. There have never been more people interested in PropTech, and since 2015, global venture capital investment in PropTech has grown from $1.8 billion to nearly $13 billion. Further, the torch is being passed from the West Coast to the East Coast. New York City is poised to benefit disproportionately from the interest and investment in PropTech. Ryan Williams, CEO of Cadre, which was recently valued at $800 million, and counts Anderson Horowitz and Goldman Sachs among its investors, said, "We wouldn't have been able to start our company with this scale anywhere other than New York." What's interesting is that Cadre sees New York City as a hub of antiquated industries, which is ripe for their disruptive technology. So as such, we're pleased to announce the addition of a real estate tech panel to the conference this year. Real estate tech will touch every aspect of these traditional real estate categories and more. We're joined tonight by 3 leaders in real estate innovation. Based in New York, their firms are cementing this city as a hub for PropTech activity and transformative real estate business models. Without further ado, I'd like to kick off the panel and invite our panelists to join me up the stage, please.
Which one?
Thanks.
This one?
Yeah, that
Oh.
one. If you want to sit here, please. Sure. Grab the middle, please.
So to kick things off, if everybody could just give a brief intro about who you are, where you currently work, and your current role, and how you got involved with real estate.
Thank you. I'm Andy Levin. I work at Ollie. I run our real estate partnerships. So I am pitching investors, developers, why they should work with us as their co-living operator. So I work on sourcing new deals, structuring our deals, and helping to market and lease our buildings.
Hey there, I'm Jeff Lewis. I'm head of product at Honest Buildings. So we have a software that real estate owners use to more effectively manage their construction, make sure their projects are on time and on budget. I think that's what Chris was alluding to with Apple's slightly behind schedule and over budget headquarters there. And so as sort of product leader, I'm basically responsible for talking to our customers, figuring out what they want out of our product, what we're doing well, and then shaping our roadmap and working with our engineers to develop our product to sort of better meet our customers' needs.
Cool. Hi, Jeffrey Berman. I'm a general partner with Camber Creek. We are likely the first real estate tech only venture capital firm. We're an outgrowth of a family office that was involved in, or that still is involved in real estate development and management. And we recently raised an external fund comprised solely of other real estate families and institutions, and the idea being that within this LP network, if we can use the product software service within that LP network and within their portfolio matrix, we'll look at investing and hopefully put the thumb on the scale for these companies.
Terrific. So to kick things off, real estate is an unbelievably complex industry. It encompasses a number of both public and private actors, a number of different professions, and I just want to start with a really fundamental question, which is, how do you define real estate tech? There's a number of terms that are thrown about today: prop tech, real estate tech, commercial real estate tech, probably my least favorite, realist tech. I hope that doesn't catch on.
You should all forget that he just said that.
How do you define real estate tech?
So we define real estate tech as anything that touches the built world. So if you think about this building, right, you can see the BMS system, the PMS system, the building management system, the property management system, the actual physical assets and attributes. Technology can be applied to all of it. And so anything that can be applied to anything in the built world, we would consider real estate tech. And it can iterate out of just the physical plant, also into operations, et cetera. You want to take us down?
That sounds pretty good.
Yeah, it does.
You want to add something to that?
Yeah, no, when we think about real estate tech, our company, we're a a co-living operator, and we very much focus on micro-housing. So we are not a software company, but when we do think about the disruption that we are providing, it's really from the design of the buildings. So when you think about an apartment building, the built environment, we view that really as an operating system. And then as we plug our users or our residents into the apartments, we're trying to think about how can we, use technology to create less friction in their living experience, whether it's from pressing an app that's going to open your bedroom, your bed before you get there, or is it helping to find and partner with a roommate, so things of that nature.
Excellent. I mean, we all know that there's no more city where there's friction in the living experience than New York, and so within the real estate tech industry, there's dozens of startups hoping to alleviate this friction. However, the friction is there for a reason. The real estate industry is historically slow-moving, it's opaque, and it's highly conservative. So when you have this dynamic of these startups with the ideas that will radically transform the industry, but these conservative players, how do you think this dynamic is going to play out? Are they going to be butting heads, or are there going to be more of a collaborative environment?
Well, from our angle, so Ollie's an asset-light co-living operator, so we don't actually own our buildings. So we get involved in these projects very early on, sometimes before there's even a schematic design in place. So I'm hoping it will be a collaborative environment, because we are not the capital, we are not the groups that build. And so far, that is what we've seen. We've seen a very much a collaborative process environment. But, as you said, it is an opaque, it is a slow-moving industry. So convincing, an owner of $100 million building to build the way that we asked them to build to our specification, as opposed to what they're used to over the past 40, 50 years, and these groups have pretty strong track records, it's quite difficult.
I think that's totally right. I mean, I think that real estate is an incredibly expensive asset class. It typically is one that people look to for stable, safe returns. So I think a lot of times people aren't looking to take tremendous risk with what they're doing with their assets. That said, I do see the industry starting to change. So, I think that one of the things our CEO at Honest Building says is that the 3 questions we get asked every time we're trying to sell our software to a new real estate owner is, who else is using it, who else is using it, and who else is using it? So I think that as basically the market starts to say, hey, technology actually can make us better, right? We obviously sell software, so it's a little bit easier for us to sort of get ingrained within the existing workflows of this industry. But I think that as the industry gets younger, as family real estate companies move from, an older sort of generation to the next generation, I think we're starting to see things like that change. So, we just raised a Series B round, and some of the investors that participated were the Rudin family in New York, the Durst organization, and I think people at those companies, it's not the person who maybe built the company in the 1920s who's investing in technology, right? These are the next up and coming generation. And so I think as younger people who've sort of grown up with technology in their daily lives, they're booking restaurant reservations on OpenTable. They're looking at Yelp to see what restaurants are good. Like, they come into work and they don't have any tools. I think that throws them for a loop, and that's definitely what we've seen. And I think that is starting to change. But it is truly amazing when you walk into some real estate offices and you see some folks in the back who are like working off green screens, kind of keeping accounting systems up to date. There's definitely a lot of opportunity for efficiency in the industry.
So the only thing that I would add is that, anybody who studied marketing would know that changing consumer behavior is difficult. Well, try changing organizational behavior, especially when you come from in a large organization, like let's say CBRE, which is one, I would say, the more tech-forward, large enterprise companies, or Cushman & Wakefield, that they're trying to adapt, but they have thousands and thousands of people that it trickles down to. So it's not just the CEO says, oh, I think tech is really cool. It's got to go all the way to the person at the bottom of the totem pole who's going to have to change their behavior. And then you look at legacy organizations and you say, well, wait a second. We've been doing it this way for 20, 30, 40, 50, 60 years. If it ain't broke, why try to fix something that's broken? One of the things from a venture capital perspective that we look at is the solution that's being pitched actually a simplification / lessener of friction, or is it just a fancy, is it just trying to create a better mousetrap with tech that doesn't necessarily need to be there? And that's something that also is pervasive right now because we're getting into a bit of a frothy environment where that chart that you showed at $13 billion of investment coming up from when we started in 2009 where it was under 100 million. And you're starting to see people really, because real estate is the largest asset class in the world, but again, changing those behaviors, that's still just a drop in the bucket.
Exactly. So in the real estate ecosystem encompasses so many different different components. The life cycle, from the life cycle of a building to in conducting the market analysis, construction, brokerage, property management once the building is complete, and then also real estate investor services. Which component of the real estate value chain do you think is most ripe for disruption right now?
All of it. And no, I'm serious, all of it. Because if you look, like for instance, right now I'm doing diligence on half a dozen companies that are, some are in multifamily and rent tech. So the way, think of not just the way you pay your rent. I mean, how many people in here rent apartments? And how many of y'all write checks every month? That's actually surprising. I'm surprised, but until that gets down to zero, that'll tell you that that's a huge area of disruption. Buying your insurance, the way you travel within an urban environment. We would consider Lyft, Uber, Via. Those are also part of the real estate tech universe. Construction is a massive massive opportunity for disruption because of the way from BIM compliance to what is actually on the as-builds to what is actually being developed. I mean, it's a completely wide open book.
Yeah, I totally agree with that. And I think to your earlier point, I mean, it seems like some of the earlier successes in real estate were things like Zillow or StreetEasy, where, they're not the most complicated parts of the value chain.
Right.
And I think now we're sort of seeing, hey, in order to create the next generation of improvements and advancements within real estate technology, a lot more is moving into that commercial side. And I think things just end up getting so complicated over there. There's so many agents and brokerage firms like CBRE, for example, just thinking about all their different business lines. And there's just an incredible amount of money and sort of layers in that ecosystem that, to me, that's a place where I think there's a lot of opportunity. Definitely unclear how you displace that, but it just seems like there's got to be something there given all the different actors and agents there.
There's just one thing I was going to add. The way real estate is also transacted is going to fundamentally change. So when my dad wanted to buy stock when I was a kid, he would call a stockbroker, he would call a market maker, he would call a trader on the floor. That doesn't happen anymore. You can trade stock on your phone. Right now, the sales ceremony for real estate is discovery, so you're starting to see like the Zillows, the Redfins, but the actual process is still quite analog. We're investors in a company called Bowery, which is and I would consider that tech-enabled, so not necessarily a pure play software company, but tech-enabled, which I would consider you guys as well, where they do appraisals in 75% less time than the current appraisal using algorithmic, actually I won't go into that, but the idea that for a real estate transaction, you could discover something online, you could do your diligence online, you can get your appraisal done online, you can get everything done in that value chain and be able to buy it right on your phone, and not soon, but maybe within the next 5 or 10 years, you'll be able to trade in and out of actual real property as easy as you can trade out of stocks.
Fascinating. So from everything we've discussed, I mean, this real estate tech has so much promise. It's going to save landlords money. It's going to help businesses make smarter decisions. It sounds like a no-brainer. But what do you encounter as some of the largest obstacles to adoption?
So for us, I mean, I think you said it earlier and you said it well. It's don't fix what ain't broke. Whereas, our argument is that, excuse me, the environment's already broken. And using New York City, for example, and we discussed this earlier, too many people in a lot of these gateway markets, these very high cost, unaffordable markets, are putting up illegal pressurized walls. They're adding density illegally just because they need a place to live. That's actually how our business got started. One of our founders rented a 1-bedroom in the financial district, put up a couple walls, turned his 1 bed into a 3 bed, so he had no living room, and he put those 2 spare rooms on Craigslist got 90 hits in the first day with people saying they'll take it sight unseen, they'll pay more than he's asking. So he took it off Craigslist, raised the price 4 or 5 times to temper demand. He finally settled on 2 people that were going to pay him the equivalent of what the apartment was. So he lives rent free. So if you take that learning, that's what we are doing, but we're doing it in a code compliant and marketable fashion. So our argument to a lot of these developers who've owned plenty of buildings over the last generations, although they're at 98% occupancy, our view is we will get you 98% occupancy as well, but we'll make you 50% more on that asset.
Something you said actually spurred a thought. So if you think about the last 10 years where we've had a fairly uninterrupted boom in certain types of construction, specifically multifamily, especially for those of us who live here, you can see a new multifamily building seemingly going up almost on a monthly basis. That's actually going to stop because this is, I believe, in the first time in, I don't actually know how many years, but the absolute dollar value for rental rates are dropping, which means that there's an overbuild and a dramatic one at that. Now that's a good thing as far as renters go. New York City's still growing, so it's not a demand problem, it's a supply side problem. Too much supply was built. Well, a lot of the folks who are jumping into tech right now, and this goes to your question, are looking at this problem and saying, uh-oh, we built something that may not have a place in the market. We've got these vacancy losses because we have huge construction loans that we're going to have to deal with. What can help us mitigate that problem? So something like Ollie can. Something like, well, there are a handful of others, but I won't mention them here because he's sitting right here. But the idea that you can use tech and that this is a solution or at least a band-aid to a problem that is occurring of their own making, because cheap money makes everyone brilliant and cheap money makes everyone want to develop things. When the market starts to turn, you have to think, uh-oh, how am I going to save money? So it's going to be, you've heard the expression, necessity is the mother of invention. This is one of those things where necessity is going to drive people to tech to realize that is the way that they're going to be able to save their bottom lines.
Yeah, and just one thing to add to that. I mean, I think that, when we're in sales meetings kind of showing off how our product could help people run their construction process more efficiently, a lot of times people will look at it and say, all that seems great, but I've been making so much money over the last 10 or 15 or 20 years as the price of commercial real estate has continued to rise, that I'm not that interested in paying money to use your software to gain a little bit of efficiency. And so I do think that, to your point, necessity will become sort of the mother of all invention. And I think at some point, as the market, again, it's been, I think, generally with obviously one exception, has been pretty good over the last, bunch of years. And I think as that starts to soften a little bit, that'll cause people to sort of rethink the way they do their business a little bit. And I think that'll be helpful for technology.
Excellent. And there's a lot of new buildings coming online, but certainly New York has a lot of older housing stock as well. Do you perceive that to be a barrier to rolling out some of these new technologies of buildings that are older and more difficult to implement, or is that really not a concern?
Actually, I think it's the opposite, because if you look at especially the legacy families that own a lot of these old properties, so one of our portfolio companies is called Latch, and they are a digital lock company. But they're not just a lock, they are creating an access control platform. I'm sorry if I'm ignoring this side of the room. I'm going to turn toward you guys and feel I'm not getting enough FaceTime here. The older buildings are going to have to work twice as hard in order to get the same market share that they used to as new buildings come online. Again, it's a supply and demand function. So a new building comes online, top of the line finishes, and they're not going to be able to get the rents that they're trying to achieve that they had in their pro forma. They drop their rent. Well, what happens to the older building? They've got to drop their rent too, or they have to iterate. And so what's happening is a number of these older buildings are starting to say, well, this brand new building doesn't have a latch lock in it. That is the most cutting edge digital lock and access control platform in the market. We're going to spend the money to buy that so we can try to keep our heads above water and compete. So I think the older buildings are going to have to work twice as hard, and so they might be the first ones to iterate and pivot beyond the brand new builds that are obviously bringing in lead technology and all the fancy bells and whistles that they're doing. But I think you'll start to see some of the older buildings, if they can, they will try to quicken their pace of adoption of technology.
Great. So we saw with that chart that there's just been a hockey stick trend in terms of interest in prop tech and in terms of venture capital investment. We've also seen the sky high valuations of companies like WeWork, now valued at $20 billion. Where do you think we are in the real estate tech cycle? Are we at the foothills of Mount Everest? Is there more room to run, or should we be getting a little concerned here?
You want me to answer it first?
Well, I'll go first. I mean, so I think that
You just got a whole big check, so you should answer it first.
right, exactly. So I mean, it does feel very much like we're in the early innings of this thing, right? I mean, like, just the reality is there's so much efficiency to be gained, as you mentioned, across all of these different segments. So, you could look at an individual opportunity and maybe, parse it out and figure out if it's a little bit overvalued or not. But I think that the trend of this being a real important sector of the economy that hasn't yet really adopted technology and needs to, I think that's a mega trend that's going to be here to stay. So, again, is WeWork maybe overvalued? Potentially, but it's hard for me to say. And I also see that, for example, we're a 65-person company and we're based in a WeWork space, right? And the reason we do that is because we can sign a 9-month lease, right? And that's pretty disruptive relative to, what all the other landlords in the city can offer us. So, I don't think people generally think of WeWork as sort of catering to, say, like a 65-person company. You sort of think of it as a 1 or a 2 or a 3, 4-desk office. But I do think that there is some like fundamental disruption happening in the industry. And, again, this is just like the early innings of what I think is a much longer game.
That was well said.
Okay. So when we started looking at real estate tech in 2009, I like to say that it was at its embryonic stage. It was just conceived. I would say that now we are only at the infancy. So I agree with you completely. What I would say is that we are at that age where, if you have kids and you see like the kid seems to like shoot up in growth when it's an infant, it's like, oh my God, it's getting bigger, bigger, bigger. And you're getting so excited, but then you might like, oh, I'm buying so many clothes and this and that, and you overshoot the runway on your infant. That's what's happening now, because there are a lot of companies that are coming out. We've only invested in 29 companies in 9 years. We have a very high bar for investing. So that means that for at least germane to our fund and the way we operate in the real estate tech space, there are hundreds, if not thousands, of companies that are pursuing strategies that really might not have a market fit, but are getting funded because there is so much excitement around the space, because real estate is the largest asset class on the planet. And so while we are definitely at early innings, I think right now we're at a little bit of an excitable phase. I think we'll calm down. There will be a number of clear winners and clear losers. I won't speak directly to WeWork, but I will give them credit as far as creating one of the trends that we look at is the hospitalityization of office space. So this space that we're in right now is an example of that, where there was this company, they're still in business, they're called Regis, but it used to do the office space that's that's month to month or whatever, but WeWork systematized it and they programatized it. There's a company called Notel that pitches themselves as WeWork for enterprise. So after 65 is probably an anomaly within a WeWork, but they're trending more towards going to a real estate developer and saying, instead of us renting these floors from you, let us actually manage them for you within your building and create a wholly separate identity and organism in your building. And again, that's WeWork was one of the creators of that segment. So again, we are still at early innings. There's a lot of room to grow, but I think you'll start to see a little bit of a breakdown in the amount of deals that are funded and the amount of money that's going into them.
Great. So one of the things that I find very exciting about the prop tech is the fact that traditionally Palo Alto, San Francisco, Silicon Valley have held the mantle of being of where tech happens in this country, but it feels like New York City is attracting a lot of interest from prop tech companies, from a lot of startups. In fact, a number of the most highly valued startups are based in New York City. What do you find are the advantages and the disadvantages of being based in New York City?
I mean, the disadvantage is just the high cost of living, which I do view that as an advantage as well. Because what we are doing is we're trying to deliver it through the micro aspect of what we do, the micro housing aspect. So what we do, we are delivering a sharper price point to the end user, to our residents. So if typical studio is 2,500 square feet and $2,500 a month and 500 square feet in the city, we're gonna, do a 300 square foot studio for $2,300 a month. So there's, $200 savings there. And then secondly, we're giving you furniture, we're giving you weekly housekeeping, giving you a TV, cable, Wi-Fi, sheets, towels, linen. So it is this, hotelification of the residential, living experience. And, there are hidden living expenses that a resident will naturally incur if they do not live in an Ollie building. We are delivering those into the experience. So we're also eliminating all these hidden living expenses. So we're going to save you on your monthly rent, and then you're also not going to come out of pocket for anything else.
Yeah, I mean, look, New York is definitely a high-cost market, right? But I also think that, especially relative to Silicon Valley, there's probably an argument that engineers are actually not as expensive here in New York as they are there. So, I mean, I think it's definitely a high-cost environment, but I think that for us, it's definitely worth it to be here because, probably like 40% of the top REITs in the U.S. are based in New York, right? So if you want to build a business around selling to large real estate owners, there's truly no better place to be than New York, right? Trying to do that in San Francisco, yeah, there are some marquee names out there, but there's certainly not the density of real estate folks that there are in New York. One other thing I'll say is that I think in San Francisco, Silicon Valley, there's an incredible war for talent out there. There's just an insatiable need for, computer scientists, engineers, data scientists, product managers, designers, all the rest. And I think in New York, what we've been able to do is, pull engineers from Goldman Sachs, where they're working on, building out internal proprietary trading technology. And at the end of the day, being able to say, hey, you can come work at a startup. You can wear jeans and a t-shirt to work. You can get paid a similar amount, maybe a little bit less, but similar-ish to what you were getting at Goldman. And you can hopefully work on something that, has a bigger impact than just sort of, making an extra dollar for Goldman. That's been actually a really attractive recruiting for us. And then similarly, there's a lot of folks within ad agencies and things like that in New York. So I think there's just sort of a different candidate profile, and folks are very interested in getting into startups. And so I think for us, it's actually been a really good place to be based, both from that customer perspective, this is where our customers are, so this is where we need to be, as well as finding the right people to actually help us build and develop and sell our product.
Yeah, there's not much I can add to that except for that New York is the best microcosm for real estate tech on the planet. That might change in a handful of years, maybe 10 years, where you have some of the other global cities emerging. But the density here, coupled with the amount of talent, the university system, this just makes an ecosystem that lends itself to continual evolution, and that's what real estate tech is all about: evolving real estate.
Excellent. So I frequently reference a quote by Bill Gates, who said, we overestimate the change that will happen in the next 2 years, but we underestimate the change that will occur in the next 10 years. Do you feel that there are any areas where the industry is over-promising in the short term, but potentially that we are discounting at the moment? So, what is the next thing that's going to radically transform the landscape of the next 10 years?
That is a huge question, and it's a huge question because it depends which locution within real estate you're talking about. So, I think as far as urban planning goes, autonomous vehicles are probably going to have the largest impact as far as urban planning, because right now, so like when I was a real estate developer and we wanted to put up, let's say, a strip mall, you had a specific parking ratio that you had to build to. That's going to disappear. Just continuing on the retail theme, AR, VR, 3D printing, AI, facial recognition, all of these things are going to completely change the selling ceremony of how a consumer interacts with a brand, with stores, with retail, with their buildings. So I think there's a lot of room to run on all of those, and I don't know. I think people are hearing like the overpromise of AR. I think they're thinking it's going to happen very quickly, but it's going to feel like overnight when it actually gets introduced in reality. And when Apple and Google are starting to spend serious time and promoting it, it's coming sometime soon.
Yeah.
I mean, I agree in terms of autonomous vehicles and how to think about the planning, and especially with the parking ratios. We're always trying to push for lower parking ratios. I mean, for us, what will the next 10 years look like? I think unfortunately because the construction process and cycle is so slow, we're trying to plan, 3 years ahead. What's the consumer going to want? What should the building look like? What should the amenity space look like? So, I think for our business model, we're trying to think. I think we have many Ollie buildings throughout the country, but it's a 5, 10, 15, 20 year path.
Great.
I agree with all that stuff.
You are agreeable.
And Andy, given that co-living is a relatively new variant on a traditional multifamily asset, what's the process of getting institutions comfortable with financing ground up? I know you have the new project that's about to come online in Long Island City. Can you just discuss that process a little bit?
Yeah, sure. There's a lot of hand-holding because we are focused on large-scale institutional product. So the $75, $100, $150 million projects. Our Long Island City project was a $350 million project. So when you have that level of institutional capital, there is a lot of hand-holding and a lot of diligence and a lot of selling into these groups to get them comfortable with putting that much risk on the table. So what we do is we are always showing how there is this downside scenario. What's the fallback option? It's also trying to persuade them or really show a lot of these developers and the capital partners that what we're doing isn't that unique at the end of the day. And if you go on Craigslist Rooms and Shares any day of the week, you're going to see thousands of listings for illegal bedrooms that are not safe for people to live in, which is what, as I mentioned earlier, what our founder did. So it's showing them that what we are doing is, although there's this term co-living, which is trendy right now, people have lived with roommates forever, and it's not going to change. And especially in a lot of these markets where we're playing, there is a need for it because of how unaffordable a lot of these markets are.
And do you spend a lot of time analyzing the layouts and especially in the event that you have to go to that fallback option, would that be converting a co-living space to like a larger, like a traditional three bedroom, something like that?
Yeah, we spend a lot of time with the architect of record. We spend a lot of time with developers, devising what's the right floor plan. How should we design this building that is optimized in such a way that yes, it can achieve the enhanced economics that we can we think we can achieve. But also, if it doesn't work, if the next buyer isn't looking to do a co-living scheme, how can we very easily flex that building back? So that is why we're very, very, very focused on getting involved in these projects early, so you can blast out a few walls within the units, and it's going to be very cheap to convert, and it'll be very seamless to convert.
Jeff Lewis. So Honest Buildings, the original model was a LinkedIn for real estate, which matched developers with architects and construction firms. What precipitated the pivot to focus on the construction management platform?
Good question. So, I think that to one of your points from before, at some level, you need to look at all these new technology businesses and figure out what's viable, right? And I think basically what happened for us was that model, I think, got a lot of excitement both from owners and developers on the one hand and contractors and architects on the other. But we, as a company, could never actually follow that transaction through to the finish and actually make money. So at some level, we had to look at ourselves and look at our investors in the eye and say, hey, what we're doing today isn't working, and if we don't transition to something different, we're going to be in a tough spot in 6 or 9 months. So that basically, necessity is the mother of all invention, and we basically had to look at what we were doing and figure out what were the good things, what were the bad things, and what did we need to change to get to this new model. And so, for us in particular, this is sort of like the much talked about startup pivot, if you will. We basically looked at our two sides of the marketplace. We had contractors on the one side, and we had real estate owners on the other, and we sort of made the decision that, contractors, there's a lot of them. It's a pretty fragmented market. They have pretty poor margin profile and kind of bad cash flow and economics generally, and they're not known for being the most technologically savvy. On the other side, you have these real estate owners who, basically own really stable, potentially cash flowing assets. They've historically underinvested in technology. A couple of them had invested in our business, and our CEO had come from Tishman Speyer, which is sort of one of the preeminent real estate owners in all the land. And we sort of said, this is where we want to go to. And we just sort of made the tough call to say, hey, real estate owners is where it's at. Let's go build software to help them manage their construction activities more effectively when they're dealing with their contractors. And at the time, I think it was a good idea, but it didn't prove itself to be a great idea until a few years later, and it obviously worked out for us. But that's kind of how we thought about it originally.
Great. Yeah, it's so important to be able to be nimble and to react and take the steps that you need to, even if you've incurred these sunk costs, to really focus on what the market is demanding.
Yeah, and then one other thing I'll just add to that, going back to your point around Ollie, I think the big difference between building a technology company and building a building is that, there's a lot less capital that goes into building a technology company. We'd raised a few $1 million, but our ability to sort of pivot on a dime was much easier than, if you guys are halfway through a $350 million project, there's just so much more capital that goes into that. I think that's one of the reasons that it is so difficult to get people to accept a new idea. There's just so much capital at risk, and I think that's one of the reasons that the industry sort of gets stuck in their ways a little bit, is that, just to reduce that risk, because it's not as simple or as capital efficient as building a software company.
Excellent. So, Jeff, I have one for you. So is real estate focused venture capital any different from generalist venture capital? And if so, what are the unique challenges that you find that are associated with investing in real estate focused businesses?
They're very different. If you imagine this room as the landscape for all venture capital, this podium is real estate tech, maybe even smaller. And what that means for us is that we do not look at anything outside of our expertise, because we can't add value. So every good venture capitalist, whether they're sector specific or a generalist, will say, yeah, we have to add value. In our case, my partners and I all come from real estate development and management and operations. So we know the pain that the developers, the landlords, the operators, the contractors, et cetera, have all been through. And so we can take that expertise and apply it to the companies that we're looking at. So what does that mean for venture capital? I'll give you an anecdote, and I won't mention the company's names. But there's a very famous VC out in the Valley that approached us with a company that did curved wall manufacture using 3D printing, and they sent it to my partner. And they said, this is amazing. We build this wall for $300 a square foot, and it's going to change the way curved walls are built. So my partner, who didn't have a construction background, said, oh, that sounds really cool. He walked down the hall in our office in DC and asked one of the construction partners in the office, hey, what do you think about this technology? And he said, oh, well, how much is it going to cost a foot? He said, oh, $300. He said, I can do that for $80. So that's one of the things where if it ain't broke, don't try to fix it. And when my partner went back to this VC and said, yeah, here's what's actually on the ground, they had no idea how to do the diligence around this. It didn't occur to them. And they're a very well-regarded, very large firm, to just call a Tishman Speyer or a Clark Construction or a HIT and say, hey, how much do you build these walls for? They just thought, oh, well, this company's telling us it once cost $1,000, now it costs $300. So what? So we, as sector specific, can look at that and say, yeah, this is right, this is a fit, or this is not a fit. Whereas generalists, and we like the generalists because, let's face it, we're still in a market-based economy in venture capital. You need the generalists to go in there, especially in the later rounds. But sector specific, if you can, I don't know if there are any founders in the room, but if there are founders in the rooms and they're specifically trying to have an application towards real estate tech, you really want to find the folks that have some kind of sector-specific expertise in that, just because selling into real estate is really difficult, as actually both of you obviously know. So,
Yeah.
And one thing I'll add is again, somebody who just, works at a company who just raised a round primarily from real estate owners. I mean, the value added there is the ability for them to pick up the phone and call their friends who work at the real estate company down the street and say, hey, why don't you check this out? Right? I think that there's
we're using it, you should too.
Exactly. We're using it, you should too is basically the key. And there's so much noise now in the real estate market given all the new companies. People are sort of inundated with this stuff. So if you can sort of cut through the noise because you have a relationship with somebody there, it can just be really helpful. So I think a lot of the VCs in Silicon Valley sort of pitch themselves and value added in terms of building your company, right? Like, hey, we can introduce you to top executives and engineers and things like that. And that is incredibly important, especially if you're building a software company like we are. But I also think that if somebody can invest in your business and say, hey, we're going to introduce you to customers, there's pretty much no thing more valuable than that. And so I think, like you said, to the founders in the room, if you can partner up with somebody who's sector specific and can provide you those types of relationships or introductions to customers, I just think that's incredibly helpful.
Excellent. And when you're thinking about either hiring new talent or making an investment in a business, how important is that real estate experience, or do you value outsiders?
In what way? Hiring for what?
Well, for these two guys, when you're making a new hire, when you're contemplating a new hire, and for you, maybe it's more about evaluating a startup, and they don't have a background in real estate, but they have an idea that can change real estate. How important is having a background in real estate?
For a founder, having a background in real estate is important, but not absolutely necessary, because specifically germane to Ollie, I don't know that your founder had a real estate background, but he experienced a problem firsthand. And so quite a number of the entrepreneurs that we invest in are experiencing a problem in the real world and saying, why is this done this way? This is so stupid. And I'm going to fix it, because they don't know how difficult it is in the real estate world to apply new technology. There are a handful of firms a handful of portfolio companies in our universe where the entrepreneurs had zero experience in real estate, and that actually helped them out. But it depends on the complexity, and it depends at which point they're trying to enter.
Yeah, I'd say too, I think if our founders actually had a background in real estate, they probably wouldn't have gotten into this business, because they learned the hard way how difficult it was. Over 2.5 year period, they met with literally over 400 institutional investors and developers pitching this idea, and the common response they got was, we get it, we like it, we'll do your second building. No one wanted to be the guinea pig. And they had left their jobs in finance when the New York Department of Buildings and the DOB signed off on what was a code compliant product, apartment unit. So that's when they thought they were off to the races. And what they realized was that it's such a slow moving industry. It is a lot of people that think don't fix what ain't broke, and it's a very, very, very conservative capital base, because especially in New York City or San Francisco, as an investor, you're comping against government bonds. So it's essentially a riskless asset, is how some people may want to think about it. So when you provide innovation is risk, and an investor does not want that, does not want risk when they're investing in a very safe haven asset class.
And with that, I think it's about time to open it up to the audience. So, are we going to be running these mics? Any questions?
So I run a co-living space in the townhouse market in Brooklyn, so much smaller than Ollie. And my question goes to you, Andy, is also, like you said, innovation is risk, but at the same time, there's a cultural shift happening too, because there's another side of real estate which makes it really complex, is also this where we live our lives, and the way we're living is getting affected in so many ways beyond real estate, also technology, culturally, familial, and I think also like living in communities and people looking to be a part of that, not just for cost reasons, but also for social reasons, and all those things combined can also end up some of this product not be able to move on the market. It's not something like townhomes that were rented to families, back whenever, and that's not a desirable thing anymore. And that's what we see a lot in the space, and that's a pain point for the owners. Just wanted to get your opinion on that, because I feel like it's riskier for them to stay that way.
So, look, you're preaching to the choir, right? I'm long co-living, so I agree with you, and that's also part of my pitch. Like our building in Long Island City, I think there's 5,000 new apartments that are going into Long Island City between now and however long. My argument is that having Ollie in our building, we're only in the bottom 1/3 of that building, so it's floors 2 to 15, and the rest, up to 42 are conventional apartments. My argument is that we're actually de-risking that asset because we're going to be stratifying the price points, marketing to a totally different audience. It's a totally different product and experience relative to anything else in the market. I think the entire building should be Ollie. So I'm with you. And when you think about, 40 years ago, the average age of marriage was 22. Nationally, today it's 28. But in, New York, San Francisco, Boston, LA, a lot of these gateway markets, it's over 30. So if you think about what the housing stock looks like relative to 40 years ago, it's pretty similar. However, the consumer tastes have changed, to your point. Consumer preferences have changed. So our view is the housing stock needs to actually meet the need of today's consumer and today's renter. And that's why, again, I keep talking about Craigslist, but that's why that's essentially the de facto roommating platform and, underground housing market.
Hello, this question is for Jeffrey Berman. So you said earlier that you think that within 5 to 10 years, people will be able to do transactions basically online from the beginning, from start to finish. And you use the financial industry as an analogy that made the same transition. It took the financial industry, I think, 15, 20 years to actually go through the whole cycle. So I just wanted to ask, I'm sure you really do believe that this will happen. I wanted to ask if you could give me some context for why you believe this will happen. People believe it. Does that understand?
No, that's a great question. It actually took a hell of a lot longer than 20 years for the financial industry. It took, 300 and something from when the first stock was traded. But what happened was the pace of innovation, the quickening. Does anyone know what ECNs are? Electronic communication. Okay, so you clearly know from what you're talking about. So ECNs are electronic communication networks where in the, I guess it was really like the early 90s to late 90s where they started to become prominent, where you could start trading online. The reason I believe that the pace of innovation will quicken is something similar to Moore's Law, where the amount of bandwidth and broadband space that we have for innovation within the tech space, actually, I don't know what the equation is, but it is outpacing even the slowness of real estate, of transactions. And when you have listing platforms that are starting to say, okay, well, not only can you list your property here, but you can actually start to underwrite your loan. And I'm sure you're familiar with some of the programs that you can already do that. Auto underwriting, auto appraisals, auto title, auto legality. So I think 5 to 10 years actually, and I didn't even start to talk about blockchain. I think 5 to 10 years may actually be putting it even a little far, but I'm a futurist, so I'm hoping for that. The downside, of course, is the commoditization of our industry, where the arbitrage play that developers used to be able to take advantage of with asynchronous information and being able to take advantage of things that wasn't necessarily available to another developer. I think that's coming to an end, much like the financial market. So that's the context that I think. That's a guess. I could be wrong. I love being wrong, but not when I invest, which is why I haven't invested in any of these platforms yet.
Hi there. My name is Groom from GoLocker. We're in the parcel locker technology business. We're based in Berkeley. My question is more around, because many of us know, we buy a lot of things online, and one of the most disheartening things now is we can walk down, say, Spring Street, and encounter tons of empty retail spaces. So I'm interested in, like, what are you guys seeing in space in terms of repurposing that space for the modern, for us today?
That's an awesome question. So one of the themes that we're really excited about is the uputilization of underutilized space. So are any of you familiar with a company called Spacious?
Yeah.
So Spacious is super cool because you have these restaurants, let's say, that are open from between 5 p.m. and midnight, and they're open for their cocktails and then dinner and then maybe cocktails afterwards, but they're closed during the day. That's so stupid because they're paying for that time. Spacious figured out, oh, hey, we can actually host co-working locations in these spaces in the parts that are not necessarily necessary for the prep time for the kitchen. Retail is going through a similar, I think, evolution. It's going to be slower, and part of the reason you have to also look at the causality of what's happening.
Right.
Real estate trades at high multiples when money is cheap, and so the person that's buying it says, I have to rent this space for X dollars a foot per month. Well, if retailers are going out and they're not able to afford X dollars a foot per month, then it's going to sit empty. Or they're just going to rent it for less money. They're going to lose the property because the bank is going to say, well, you underwrote it at this is where it's performing, we're taking it back. But there are a number of really cool concepts that we're starting to see. Again, it's really early days, but the idea of paying for time in a space versus paying for an actual product, where experiential retail is becoming a big deal, where storefronts are no longer, I think, Best Buy was 50,000 square feet, now they're shrinking to 5,000 feet. And so the idea that you don't really need all of this space for fulfillment, you just need, Warby Parker is a great example, you just need to be able to see what's there and then you can order it online, bonobos, I don't know how you pronounce that, but one of the two, maybe. So I think those things are going to be the stopgap, and you're going to see retail continue to transition and evolve. I hope that answers your question. Yeah, if not, I'm sorry.
In the sort of conventional tech, a lot of sort of latest and greatest started at pretty high price points and then trickle its way down. In sort of prop tech, do you see a similar story playing out, or do you see, depending on the investments or innovations, that things will really affect not just sort of like lowering the price and the margins, but drastically changing the cost of the investments?
So we basically took the viewpoint that we're going to go sell our software to sort of the top end of the market. So we actually have said, hey, the people who will pay the most for this type of software to manage their construction are the people who spend the most money on construction. Relatively straightforward. And I think that actually as we progress over time, a lot of what we do will be taking a relatively high-priced product that a Brookfield or an SL Green might buy to manage their huge volume of construction and start to scale it down to something that's a more general purpose viewpoint for the market. So I could see that. I could see that working. I think the other side of that coin is that sometimes you also see this sort of, the innovator's dilemma, right? Where you have actually a really, really cheap product that, looks kind of like a toy at the start, but eventually starts to sort of like catch up and surpass, the existing product over time. So, I think there's kind of the two ways to look at it. We sort of think of it more as, hey, we're going to start at the top and, sort of potentially, grow in volume and reduce the price over time. If you have anything to add to that. Yeah.
My name is Nikisha Lewis. This question is for all the panelists. As you underscore just how dramatically slow the industry is moving as a whole, do you think it would be helpful to work with other actors in, for example, New York City and environments where city council members and neighbors in your neighborhood have such a strong influence on decision making when it comes to policies and laws? Is it going to then be necessary for us as an ecosystem to come together and form think tanks that can function as an advocacy tool that we use to drive innovation in the space?
So yes, all the above, and that's one thing that we do. So I've spent a lot of time with in DC, in LA, New York, and Boston as well, speaking with all the local jurisdictions, trying to explain what we do, how we do it, why it's beneficial to the consumers in their markets. Getting community boards, neighborhoods, all these groups on board with what we're doing, it's difficult. A lot of just like a developer or institutional investor may not like change, neighborhoods don't really like change either. So although what we're doing is code compliant, and sometimes we can build by right, as of right, there's still a lot of resistance. So it's another hand-holding effort that we are undertaking.
That's right.
Hi, my name is Safi. I'm from Panelist staff. So basically, looking over the problematics that arise from hyper-density cities like New York, you could see that logistics and infrastructure is a big problem. How can you envision prop tech technologies to go and to deal with these problems?
Take this one, Jeff.
Sure. That's a pretty broad question. So I think it has to be segmented in a number of ways. I think urban planning is going to become, well, it's always been important, but the understanding that technology is going to change the way people work and live and how that changes, like if you think about a multifamily building that has people living in it and not necessarily people working in it, how that might change with mixed-use developments, how that's going to change what kind of parking ratios are around it, how that's going to change how congestion pricing in cities, and a lot of this has to do with mobility, because that's really when you think about density, mobility is really one of the big ticket items that people deal with, mobility and the quality of life. And so I think prop tech is not going to be a solution. I think it's going to be part of the solution that allows a manifestation of various solutions that create a better living environment. I hope that answer your question.
But I guess, there's always regulatory actions from the government to mitigate this problem. You can see Barcelona going into creating super blocks and creating time windows for services to come in. But we're still not feeling, how the technology is dealing with the public hand in hand of congestion and logistics.
So let me push back against that. So you're familiar with congestion pricing in London? Congestion. You know what congestion pricing is for automobiles?
No.
So like for instance, London is a chokingly, it's a gridlock city, especially in the center of the city. And so they started this program where if you were driving in the city at specific hours, you were going to pay a much higher fee, a much higher toll. Well, think about Easy Pass, right? That's a piece of technology. That in and of itself lent, that piece of technology was one of the things that made it feasible to introduce the type of congestion pricing that they needed to without putting toll booths all over the city. So it might not, on the face of it, look like, oh, that's a technological solution. That is a technological solution. So tech is being adopted, and it's really the only way that you're going to continue to see the evolution of cities as they get smarter and smarter and more data gets pulled up. So people have an understanding, the urban planners, the regulatory bodies have an understanding of why things should be designed the way they're designed rather than guesswork. And so it's taking the guesswork out of it. Sure.
My name is Max. I'm a graduate student at NYU. I have a general question for all of you. What do you think about the impact of artificial intelligence on real estate? I'll give you an example. According to McKinsey's estimate, about half of the jobs in the US can be automated, of which like 30% are office-based. So in future, it might happen that employers will need less employees and less office space, and people without jobs won't be able even to pay the coding rates. What do you think about it?
Well, the first thing I would say is that in every technological revolution, there's always doomsayers who say, oh my God, this is going to displace us, all the way back to the cotton gin with Eli Whitney and the Industrial Revolution. So I don't necessarily buy into the notion that technology is going to displace people. I think it's just going to move them from one function to another. I'll just take, because AI is going to have an impact on all aspects of real estate, the built world. Well, let's go back to autonomous vehicles and trucking. So you saw that Tesla had, they're launching that truck that can deliver goods one side of the country to the other without a driver. Well, that's not really true, because there's a command center that's being controlled by a human being it's still watching to make sure things are happening. So the job is shifting from the manual labor who's driving the car or driving the lorry, the truck, to the one who is actually watching the whole system and making sure that the plumbing works. So it's an education issue where we're going to have to educate our children and our children's children to be able to move from a manual labor society to a digital society, and the jobs that are going to be built around that. I have a feeling the economy is only going to improve with AI until the robots come and get us. Then
and this will be the last question, and I'm actually going to steal this one. So this is a short one for each of you. Typically in the real estate world, there's some words that pop up. Two are YIMBY and NIMBY. And YIMBY is yes in my backyard, NIMBY is no in my backyard. And so it brings forth a dichotomy between more development and less development in cities. So I'd like to ask each of you, are you a YIMBY or are you a NIMBY?
I think it's obvious I'm a YIMBY.
I'm definitely a YIMBY, but I do think that there are like real questions to be answered, right? So like if you switch the entire U.S. auto fleet from, we drive the car to self-driving cars, you're going to have way less accidents. That's just like factual. But at some point, a driverless car is going to kill somebody. So like, what does that mean from a legal and regulatory standpoint, right? So I think definitely I'm a yes, but I do think that there's some pretty tough questions to be answered as we transition from essentially one state of the world to the other.
I'm a YIMBY except for the building that's being built right next to my apartment now. So that's hopefully an Ollie building, so you'll make a lot of money. But no, obviously I'm pro development.
Great. Well, I would like to thank our panelists. And our partners. The conference is coming up on March 24th. Make sure to check that out. Our partner Galvanize, be sure to check them out, as well as The Urbanist at Facebook Live, The Urbanist. And yeah, my name is Peter Ryan. I'm the host and founder of Startup Cities. If you'd like to talk about future events or any ideas or just want to meet, come up to me and I'd be happy to chat. And once again, thank you all for coming, and please grab a drink and meet your fellow peers.
And before you grab a drink, I just want to mention one thing. If you've already purchased a ticket to come to the conference, we're very, very excited to have you. But if you haven't, we'll be blasting out a discount code to everybody here today, so you can enjoy a nice discount on that. So thanks again, and we hope you can join us. Thank you.